Welcome back to the Finance Hub, where we help you navigate the complex world of personal finance and investing. Today, we're diving into the exciting world of stock trading. Whether you're a beginner or a seasoned investor, these top 7 trading tips from experts will boost your stock market performance. Let's get started. Listen up, because this is crucial. Before you even think about hitting that buy button, you gotta do your homework. We're talking deep dive research here. Don't just chase the hype train. You need to understand the company inside and out. What do they do? What's their business model? Are they making money? Are they growing? We're talking about digging into their financial statements. Look at their earnings reports, their balance sheets, their cash flow. This isn't about just picking a company name you like. It's about understanding their financial health. Are they in good shape or are they drowning in debt? And don't forget about their competition. Who are they up against? What's their market share? You need to know if they're a leader or a laggard in their industry. Luckily, we live in the age of information. There's no excuse for not doing your research. We've got financial news websites, stock analysis apps, company websites with investor relations sections. It's all at your fingertips. Remember, knowledge is power. The more you know about a company, the better equipped you'll be to make smart investment decisions. All right, you've done your research. Now it's time to talk strategy. You wouldn't go into a battle without a plan, would you? Same goes for the stock market. You need a solid trading plan. First things first, define your goals. What are you hoping to achieve? Are you in it for the long haul or looking for some quick gains? Once you know your goals, you can set your risk tolerance. How much are you really willing to lose? This isn't about being pessimistic, it's about being realistic. The market can be volatile. You need to know your limits. Next, determine your entry and exit points. When will you buy a stock? When will you sell it? Don't just rely on gut feeling. Have a plan. And finally, stick to your plan. This is where discipline comes in. It's easy to get emotional when the market is going crazy, but don't let your emotions make your decisions for you. Remember, a well-defined trading plan will keep you grounded and focused, helping you make rational decisions even in the heat of the moment. Let's talk about risk management, folks. You know what they say? Don't put all your eggs in one basket. Well, that couldn't be truer in the stock market. Diversification is key to protecting your hard-earned money. You don't want to be left holding the bag if one of your investments goes south. Think of it like this. You wouldn't bet your entire life savings on one hand of poker, would you? Of course not. You'd spread your bets, manage your risk. Same principle applies here. Spread your investments across different sectors and industries. Don't just invest in tech stocks or energy stocks. Branch out. Look at healthcare, consumer goods, real estate, the list goes on. And don't forget about asset classes. Stocks are just one piece of the puzzle. Consider bonds, real estate, commodities, even cryptocurrencies. The more diversified your portfolio, the less impact any single investment will have on your overall returns. It's about mitigating risk and protecting your downside. The stock market is like a living, breathing organism. It's constantly changing, evolving, reacting to news and events. That's why it's crucial to stay informed. You need to know what's going on in the world and how it might impact the markets. We're talking about keeping up with economic data releases, like inflation reports, interest rate decisions, and employment numbers. These can all move the markets. Pay attention to geopolitical events as well. Wars, elections, natural disasters. These can all have a ripple effect on the global economy and the stock market. And don't forget about industry-specific news. New regulations, technological advancements, changes in consumer behavior. These can all impact individual companies and sectors. So how do you stay informed? Subscribe to financial news channels, follow reputable financial websites and blogs, Listen to podcasts, attend webinars. There's a wealth of information out there. All right, let's talk risk management again, because this is important. Even the best traders experience losses. The key is to manage those losses and protect your profits. That's where stop-loss orders come in. A stop-loss order is like an insurance policy for your investments. It's an order you place with your broker to automatically sell a stock if it falls to a certain price. This helps limit your downside risk. For example, you buy a stock at $50 per share and set a stop-loss order at $45. If the stock hits $45, your order will be executed, limiting your loss to $5 per share. Setting the right stop-loss level is crucial. Too tight, and you'll get stopped out of a potentially profitable trade. Too loose, and you'll risk losing more money than you're comfortable with. Let's dive into the world of technical analysis. This is where things get interesting. It's about studying historical price movements and trading volumes to identify patterns and trends. Think of it like reading the tea leaves of the market. By looking at charts, you can see how traders reacted to certain price levels. There are many technical indicators and chart patterns. Moving averages, RSI, MACD, Bollinger Bands, and more. Each tells a different story about price action. Combining indicators gives a complete market picture. It's not a crystal ball, but a powerful tool in your trading arsenal, helping you identify opportunities and manage risk. We've talked about research, strategy, risk management, and even technical analysis. But there's one more crucial element to successful trading that often gets overlooked: your emotions. The stock market can be a roller coaster ride. There will be ups and downs, wins and losses. And it's easy to let your emotions get the best of you, especially when you see your hard-earned money on the line. Fear and greed are the two biggest culprits. Fear can cause you to sell too early, missing out on potential profits. Greed can cause you to hold on too long, turning a winning trade into a losing one. The key is to stay disciplined and stick to your trading plan. Don't let your emotions cloud your judgment. Remember why you entered a trade in the first place, and don't be afraid to take profits when you're happy with your gains. And if a trade goes against you, don't panic. Accept the loss, learn from your mistakes, and move on. Dwelling on past trades will only cloud your judgment and lead to more emotional trading decisions in the future. And there you have it, our top 7 trading tips to boost your stock market performance. Remember, trading is a journey, not a sprint. Continuous learning and discipline are key to becoming a successful trader. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more expert insights from the Finance Hub. Thanks for watching, and happy trading!